I just got back from a business trip on the East Coast, and several viewers have been telling me that Irvine, California, is on the verge of a collapse. The number of homes for sale has shot up from around 600 to nearly 900, and the sell-off is getting more intense. On top of that, a friend sent me a special report from Wall Street arguing that the US housing market is a fake boom and is about to enter a major recession. This is a gut punch of a question. After all, the Oracle of Omaha himself, Warren Buffett, just went bottom fishing for real estate stocks. Did he get it wrong? How do we explain this? Today, we're going to start with the Irvine sell-off and the broader housing recession narrative to determine whether the current U.S. real estate market is experiencing real prosperity or just a lot of noise. And most importantly, how should we as ordinary people navigate the new challenges ahead? Before we start, please give this video a like. Your support is my biggest motivation to keep creating new content. Many people were originally waiting for an interest rate cut at the end of the year, expecting the U.S. housing market to take off. Well, I think it's time for us to abandon that fantasy and face reality. Fannie Mae and Freddie Mac, the two giants of the mortgage industry, have already released their interest rate forecasts for the end of the year. According to Fannie Mae's forecast for the 30-year fixed mortgage rate, even by the end of 2025, they don't see it dropping to 6.2%. They predict that even by the end of next year, 2026, the rate still won't fall below 6%. We've discussed this before. For the housing market to see another explosive boom like the last one, we need to hit a magic number of around 5.5%. At the very least, buyers need to see rates to 5.8% to feel hopeful enough to start entering the market. But if the forecast shows that even getting below 6% next year will be difficult, then we can forget about a boom. What's more concerning is Fannie Mae's Home Price Index forecast. They predict that in some regions, home price growth won't even keep up with inflation. For example, they forecast home prices to rise by 4.8% in 2024, 2.8% in 2025, and only 1.1% in 2026. And that's the average. Do you see the problem? If we assume an annual inflation rate of 3%, then even if your home's value is increasing, it's actually depreciating relative to the rising cost of other goods and services. This explains why in high-cost areas like Irvine, many people are dumping their properties, selling 2 or 3 homes at a time. As some viewers have pointed out, they're selling their houses to go speculate on crypto. It seems they've concluded that their real estate assets are no longer worth holding on to. Many viewers have asked me to do a real estate analysis of Irvine, hoping for a comparison between Irvine and other high-cost areas like Silicon Valley, the Bay Area, New York, and Boston. My answer is that it's unnecessary. Not because I'm lazy, but because I don't want to waste your time. In my view, comparing Irvine to these other cities is like comparing a cat to a dog. They are fundamentally different species. It would be an insult to everyone's intelligence to make a whole video explaining the difference. If you want to understand the real estate markets in those other cities, the Bay Area, Silicon Valley, New York, Boston, you need to look at their local population and income levels. Although the home prices in these areas are very high, they share a common trait. They are supported by local jobs and high local incomes. People who buy homes there are often doing so out of necessity, getting married, starting a family. You won't see a situation where multiple people in the same neighborhood are suddenly listing 2 or 3 houses for sale at the same time. Irvine is different. While the majority of residents are locals living their daily lives, a significant portion of the population has an income structure that isn't tied to the local economy. For them, buying a house isn't purely for shelter. As the viewer said, people are selling 2 or 3 homes. Given Irvine's high prices, this means they were likely holding these properties as investments. They treat real estate as a financial asset, a place to park their money temporarily, like a safe deposit box. I want to emphasize that not everyone in Irvine is like this. Many of my local viewers are longtime residents waiting for prices to drop. Why else would they be watching the Irvine sell-off so closely? The last time we talked about Irvine, A viewer mentioned there were about 600 homes for sale. I checked Redfin again for this video, and the number has now jumped to 879. So the viewer who said it was approaching 900 was pretty much spot on. It's clear that a significant number of people are in a hurry to pull their capital out of Irvine real estate and move it into other areas where they expect higher returns. So, to answer the viewer's question about whether the sell-off in Irvine will continue and when it will ease up, my answer is that we need to wait for this wave of investment-driven properties to be squeezed out of the market. Once these investors have cashed out, the market can start to stabilize. This brings us to the broader point. If this is a fake boom, as Wall Street suggests, and a housing recession spreads, what impact will it have on the rest of us? Let me summarize 3 key signs that can help you determine if your local housing market is heading into a recession. Sign number 1, inventory and sales volume. The most direct indicator is that houses around you just aren't selling. Take a walk around your neighborhood and notice how long for sale signs are staying up. The longer they're on the market and the more of them you see, the more inventory is piling up. Many first-time buyers have told me they're afraid of getting scammed because they're new to this. My advice is simple. You don't need to be scared. Just go to open houses in your area every weekend. Don't be picky. Look at 20, 30, or even 40 different homes. By doing this, you'll quickly get a feel for the local market and its inventory. Sign number 2, price trends. Don't just look at a single price drop on a single day. You need to track the trend over at least 1 quarter. I once met a viewer at a restaurant in Los Angeles who told me he regularly watches my videos to see which areas have consistently declining prices. He then does the opposite of what you'd expect. He looks for high-quality properties in those declining areas and waits for the right moment to make a move. You can track these trends yourself using data from Zillow and Redfin. Sign number 3, new housing permits. This is an insider metric that we in the development and construction industry pay close attention to. A drop in new housing permits is a leading indicator of a broader economic slowdown. Right now, the total number of new housing permit applications in the U.S. is down about 30% year over year. If developers who are on the front lines are pulling back on production, it's a major red flag. Construction is a bellwether industry. If developers stop building because they can't sell their inventory, they'll be forced to lay off workers. A downturn in the construction industry will drag down the entire supply chain with it, from building materials and furniture to logistics and retail. If the head of the dragon, the construction industry, falls, all the industries that feed off, it will also enter a long-term recession. How long would it take to recover? A typical construction project cycle is 3 to 5 years. This brings us to a new question. If even the builders are afraid to build, why is Warren Buffett buying their stocks now? Isn't that an even bigger risk? Is the old man truly losing his mind? In our last episode, we talked about Buffett's $1 billion investment in home builder stocks, which gave a huge boost to the stock prices of D.R. Horton and Lennar. A viewer commented that for Buffett, $1 billion is just pocket change and not worth mentioning. I welcome this kind of discussion. Anyone who follows the market knows that $1 billion is a small fraction of his portfolio. But the point of that episode was to look at this move from an insider's perspective in the development and construction industry. So today, I want to talk more about Buffett's impact on the real estate industry, not just on housing prices. It's crucial to understand that a builder's stock price and the price of the homes they sell are 2 completely different things. A company's stock price reflects its profitability. Even if a builder is cutting prices to clear inventory and crush its competitors, as long as its market share is expanding and its cash flow remains stable, shareholders will be happy, and the stock price will rise. So when the Oracle buys these stocks, he's not trying to solve the housing price problem. Housing prices have nothing to do with it. That $1 billion might be his pocket change, but you can be sure that a master of his level doesn't just throw money away. Buffett's move sends us 2 signals. First, the supply side of the housing industry is about to undergo a major consolidation. The big, well-funded builders, now backed by the Oracle himself, will continue to eat up the smaller players and increase their market share. Second, he's betting on the long-term essential demand of the entire supply chain. A viewer with deep industry knowledge left a very insightful comment. He said that on his construction site, he constantly sees a particular brand of insulation material being used in massive quantities. He figured that company must be making a fortune. When he looked it up, he found that it was a building materials company owned by Warren Buffett. This is the kind of valuable insight you can get from looking at the industry from the inside. Making money in the stock market isn't just about high-tech and AI. Buffett's empire is a microcosm of the entire U.S. industrial supply chain. As long as we are human, we need houses. And building a house from land and design to insulation and hardware, every step of the way is a link in Buffett's profit chain. So, Buffett's bottom fishing in a housing recession is a signal that the top players will not only survive, but will thrive. Now, let's talk about what this recession means for our own home buying and investment decisions. In this section, we'll answer a few viewer questions. A first-time homebuyer who has been looking for 2 months wants to buy before the end of the year, but is wondering if they should wait for bigger price drops. I completely understand this from a buyer's perspective. It's only natural to want to buy at the lowest possible price. But we also have to think from the seller's perspective. If interest rates don't drop enough by the end of the year, as Fannie Mae predicts, sellers might lose patience and pull their homes off the market. They might think, my house is in a good location and has a good layout. Why should I sell it at a discount now? I'd rather wait until next spring when the market warms up and I can get a better price. So, the homes you still for sale late in the year might be from sellers who are desperate to sell. You have to ask yourself, is there something wrong with the property? If you wait until the last minute, your dream home might be gone, and you might end up with a house you don't even like. As a viewer once said, for a primary residence, you should prioritize the quality of the house. I always wish my viewers the best in finding a high-quality home that they love. I never say, I hope you find a cheap bargain. A house is not a standardized product. It's not like you can just compare prices and the cheapest one is the best deal. For an investment property, you might look for a low price, but for a home you're going to live in, you shouldn't be chasing the lowest price, especially if you're a first-time buyer. To be honest, would you dare to buy a house that's suspiciously cheap? If you find a new construction home in a good location, I would recommend buying it. As I mentioned before, an old house will eventually reach the end of its life cycle and require a large sum of money for repairs. If you buy an old house, you're the one who will have to foot that bill. While the quality of new construction may not be what it was 20, 10, or even 5 years ago, you won't have to spend a lot of money on repairs in the short term. Buying a home is about choosing the lesser of two evils. Eliminate the biggest and most uncontrollable risks, and what's left, even if it's not perfect, is the best solution for you right now. The next question is from a family looking to upgrade their home by the end of the year. What should they pay attention to? The first thing is time management. In a recessionary market, you might be able to buy a new home efficiently, but selling your current home will be difficult. What will you do if you can't find a buyer? I think the priority should be to sell before you buy. Or if you buy first, try to avoid having 2 mortgage payments at once. If you can pay in cash, of course, you can avoid all these hassles. Second, you need to list out your needs. It's not just about getting a bigger space or moving to a better school district. You need to look for hidden costs. Is the old house you're buying about to need a major repair? For a new home, which upgrades should you prioritize? I would suggest prioritizing the things you can't do yourself, and that require expensive labor, like structural changes. And unless you're downsizing for retirement, I would still prioritize location over price because you might want to sell it again in the future. Many people who are upgrading make the mistake of wanting their new home to be better than their old one in every single way. If you have unlimited funds, that's possible. But if you're upgrading to solve a specific problem, like moving for a better school district or downsizing for retirement, you have to make strategic trade-offs. Strategy is the art of sacrifice. You can't have it all. Focus on solving your most pressing issue. That way, you won't get stuck in indecision. If you hesitate, a good property might be snatched up by someone else. Finally, let's talk about investment properties in a recession. With people in Irvine selling their homes to invest in crypto, is real estate still worth investing in? A viewer asked, for a conservative real estate investor, how should I calculate the minimum acceptable return during this period? You can use the 10-year U.S. Treasury bond yield as a baseline. Let's say it's 4%. That's your risk-free return. Now, if you're going to buy an investment property, which comes with risks like vacancies, repairs, and tenant turnover, you need to be compensated for taking on that extra risk. So you should add a risk premium to that baseline. For example, you might demand an extra 2% to 4%. So your minimum acceptable return would be 4% plus 2%, which equals 6%. If an investment property can't give you at least a 6% annual return, why would you bother with the hassle? This risk premium will vary depending on the specific risks of each market. A viewer commented that they enjoy listening to my show like it's a lecture from a professor. I'm flattered, but I also feel a bit intimidated. I want these weekend episodes to be a relaxing experience for everyone. So, in closing, I want to talk about the bright side of the market. Even in a recession, there's always another side to the story. First, a recessionary period is when the foam gets squeezed out of the market, and that's a good thing. When the bubble deflates, prices become more realistic, and buyers and sellers can negotiate on more even ground. You don't have to compete with a frenzy of other buyers. Just remember, there is no such thing as bottom fishing in real estate. I'll say it again for the new viewers. Real estate is not like the stock market. You should focus on finding a high-quality home that you love. A house that's too cheap is often hiding a lot of problems. Second, not buying a house doesn't mean you're being left behind. On my trip to New York, I had a great conversation with some young people there, and my biggest takeaway was that New Yorkers have figured it out. They don't tie their self-worth to home ownership. If they can't afford to buy, they move to another city, switch industries, or change their career path. They save a baseline in T-bills and then diversify their investments into things like index funds and a small amount of crypto. The adoption of crypto among young people in New York was shockingly high. I believe that every generation has its own cycle, and a recession is part of that cycle. A recession isn't about luck. It's about your current cash flow and your confidence in the future. You need to wait for the right moment to make your move, which means you need to have your ammunition, cash, ready. Don't be afraid. A changing cycle helps us see clearly how we need to upgrade ourselves first before upgrading our assets. Do what you can control and leave the rest to the cycle. I welcome you to share your thoughts on Wall Street's prediction of a housing recession. How do you see the investment risks in real estate, stocks, and the crypto world? I look forward to reading your valuable insights. Thank you for your likes and subscriptions, and don't forget to turn on the notification bell so you don't miss the next exciting share.